For the record, I'm done trying to make y'all comfortable. For the record, I'm not gonna tell the lies, I'm gonna tell the truth. For the record, I'm gonna take this thing all the way. For the record, I got a little something to say. For the record. So in today's video, we're gonna be asking the question, why does the Fed keep getting it wrong, and why do they keep breaking the economy?
Key members of the Federal Reserve are admitting they may have gotten it wrong when the central bank boosted interest rates in the wake of the Great Recession.
Also, the Federal Reserve mischaracterized inflation and fell behind.
So what does this all mean? Well, I went back and looked at some of the previous Fed forecasts. And in case you don't follow Fed history, I can tell you that their history is awful when it comes to forecasting the economy. I looked back at around 2009. They were looking for GDP growth for...
I think I was wrong then about the path that inflation would take. There have been unanticipated and large shocks to the economy that have boosted energy and food prices and supply bottlenecks.
And all these things came together
That have affected our economy badly, that I at the time didn't fully understand.
Case in the most recent period is that the Fed said they weren't going to begin to raise rates until certain criteria were met, first of all. Secondly, until they had QE had gotten to a certain point.
and all these things came together.
But we recognize that now.
I asked Ben Bernanke whether he thinks that with transparency and the forward guidance that effectively comes with that, if it locks in the Fed, for example, the most recent case of the 50 basis point rate hike.
There's no strategy that doesn't have occasional downsides. I think the clearest case in the most recent period is that the Fed said they weren't going to begin to raise rates until certain criteria were met, first of all. Secondly, until they had QE had gotten to a certain point, and they were going to taper first, et cetera, et cetera. So the forward guidance, I think, overall, on the margin, slowed the response of the Fed to the inflation problem last year, to some extent.
So does that mean it was a mistake?
Well, they had different. So this is a complicated question. The question is, why did they delay that? I think that. Why did they delay their response? I think, in retrospect, yes, it was a mistake, and I think they agree it was a mistake. There were a number of reasons for it. One of the reasons was that they wanted not to shock the market. They wanted to avoid. Jay Powell was on my board during the taper tantrum in 2013, which was a very unpleasant experience. He wanted to avoid that kind of thing by giving people as much warning as possible. Right. And so that gradualism was one of several reasons why the Fed didn't respond more quickly to the inflationary pressure in the middle of 2021. There were other reasons as well.
What do you think?
Well, one of them was that in early 2021, after the American Rescue Plan was passed, and this was something like $2.8 trillion in new federal spending between the American Rescue Plan and the December program. The Fed could have responded at that point, but they looked around and said, well, look, there's still a lot of slack because the unemployment rate was still close to 6%. The number of people working was still well below where it was before the pandemic. And so they said that, well, there's still a lot of slack in the economy. We should let this fiscal program do its job and bring the economy back to full employment. What we've learned since then is that because of the pandemic, with a lot of people staying home, that the unemployment rate, for example, the number of jobs may not be a really good indicator of whether the labor market is hot or not. And so they're looking now at things like the number of job vacancies, which show that employers are having a terrible time finding enough workers and that the labor market is distorted. The other issue that they were looking at was the supply chain issue. The pandemic has snarled supply chains around the world. That has helped drive up prices. The Fed believed in the middle of 2021 that these factors would likely solve themselves over time. That, in other words, that the supply shocks were, quote, transitory, and so that they didn't need to respond to the early stages of inflation because it was going to go away by itself. That proved wrong. So there were a couple of issues, I think, that are related primarily to the pandemic itself and the way that it scrambled the usual indicators that made it harder for the Fed to read the economy.
And that, my beautiful people, is exactly why we're making this video today. We're going to be going over the top 6 economic indicators that drive all of our economic policies, and we're going to talk about exactly why they're all broken. Stay tuned. The 6 that we're going to be talking about are first, Ebitda, which is a alternate form of analyzing cash flow in a company's fundamentals. We're going to be talking about GDP. We're going to be discussing unemployment and employment numbers. We're going to talk about the Consumer Sentiment Index and what that means. We're going to talk about consumer spending, and we're going to talk about inflation. Inflation data will be covered on CPI and PPI data combined and what their effect is as a whole. All right, so for a little bit of context, I just want to say when I was a kid, I stumbled across an old book called How to Lie with Statistics.
Heard our branch on the planet Jupiter is up 8,000% in sales.
It's a pretty well-known book. Many people read it. I got my hands on it at a young age, so it kind of triggered me into a long-running pastime that I always have had of looking into any statistics that are given at any particular time and seeing why they could be manipulated. And throughout pretty much the course of my entire history and life, we have seen these statistics heavily manipulated. These numbers that we're going to break down are things that we talk about monthly regarding the markets every single day of our entire lives. And they're all broken. All of our economic indicators are broken. So when they ask, why does the Fed keep getting it wrong? It's because they're working with the wrong data. How can you possibly forecast what's going to happen in an economy if your economic indicators are manipulated?
You know he's honest. He's honest, but you gotta watch him a little.
Now, what has happened is incrementally over the years, they've fudged and flipped and
smack it up, flip it, rub it down, oh no.
Change the number again, and they will just switch everything around to be calculated slightly different, but still look the same. And so we're going to cover every one of our economic indicators right now. The too long didn't read of this video is that all the economic indicators they're using are incorrect. Okay, first on our list of broken economic indicators, we have Ebitda, which stands for earnings before interest, taxes, depreciation, and amortization. It's a hard one for a guy from Boston to say that. So what does that really mean? It means this is how much cash you have if you had no bills at all. If you didn't have to pay any bills at all. And they try to use this as a way to buy out a company and see how much of its debt could be restructured. But it really is something that they've now used over the past 25 years as an alternative mechanism for analyzing earnings per share in a more fluid way. So it gives CEOs and accountants the opportunity to fudge and hide the numbers because Ebitda doesn't include depreciation. Anything that is bought or purchased or paid for, it doesn't include how much that is to lose value. And this is a number that is used to determine the stock price and strength of a company's fundamentals for many, many, many years. This is a non-GAAP accounting mechanism, so it can be fudged and manipulated, and the numbers can be coerced to go in their direction that they would like to. Ebitda is basically, from the book How to Lie with Statistics, the definition of how you'd want to account for things if you wanted to fudge the numbers and make things look better than they are. So, number one, Ebitda, failure, not a very good, useful measurement for analyzing the fundamental cash flow for a company. Now, first, if you want to hear what Charlie Munger has to say about Ebitda and Warren Buffett, go ahead and check this out.
More than our depreciation the year before that. You know, depreciation is a real expense. It's just as much as, you know, the expenditure for life. It's not a non-cash expense. It's a cash expense. You just spend it first. You know, I mean, the cash is gone. and it's a delayed recording of cash expense. How anybody can turn that into something they use as a metric that talks about earnings is beyond me. Charlie?
Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings.
I knew he'd do it sooner or later, folks.
2, GDP. Let's try to get through this one quick, but this has a lot of information to go over. Okay, so first off, GDP. What's wrong with the GDP calculation? Okay, first off, innovation is terrible for GDP. Anytime you create an efficiency with your company, for example, and you're able to provide, let's say, a free service to your customers, that's a negative GDP impact, and essentially because it's a free service, it doesn't include any kind of purchase or sale. And so it has a negative impact on GDP simply because you've created an efficiency where you no longer need to charge, can now provide a free service, and it can create innovation across the entire world. Let's use Gmail as an example. That's a free service that we have all used, and everybody has a Gmail account. Gmail does not do well for GDP. Some of the advertising dollars they may get from Gmail or from people being involved with Google because they got a Gmail account is great. But think about how much Google was able to grow because they created Gmail, a free service. And this is something that isn't rewarded in the GDP. This is a, really kind of rigid, kind of industrial era type of calculation. And so it doesn't affect that. Second thing wrong with GDP, it does not explain where money is going, so it doesn't measure inequality, right? So your GDP can be great, but there can be just one person who's getting all the money from that. And everybody else in the country could be poor, but your GDP would still be good. So it doesn't accurately reflect inequality. And having equality within an economy is what creates the strongest version of any economy we've ever seen in the modern era. So we want to shoot for equality in all senses. It also doesn't measure quality. Innovation doesn't help with GDP, but it also doesn't help GDP just because you're doing really nice things. So your GDP can be going up if you legalize gambling, if you legalize drug use, if you legalize porn or the sex industry, any of those things can lead to positive GDP. And as an empire ages, you see a tendency, as discussed in the book, The Fate of Empires, that during the age of decadence, that the economy tends to actually start shifting away from more kind of sound growth, industrial growth, technology growth, towards sectors of the economy that are more towards pleasure seeking and consumerism. So a lot of buying and a lot of sex and a lot of drugs and a lot of gambling starts breeding into the society. If you take a look at some of the regulations that have slowly been easing into the world over the years, also the incorporation of social media, you can see we're kind of heading in that direction. And GDP, doesn't really say whether we're doing that good as a group of people in a culture or not. Just ineffective to say how we're doing. Okay, so we've already talked about innovation, but GDP also hates efficiency. The more efficient your company runs, the worse the GDP is, because you just don't need it. So if you take less time to do something, it doesn't really help. If it costs less to do something, it doesn't help the GDP. So it takes away a lot of what the competition format for capitalism is really all about, is innovation and inefficiencies. So an inability to measure those things is going to be a problem. So what else? All right, so there's never really like a talk about environmental degradation when it comes to having a strong GDP. So you can tear your environment to the ground and it could still actually show off as a good GDP. Fukushima would be a good reaction. Actually, it was a positive GDP improvement for Japan just by having to go do the 9 or 10 years of nuclear radiation that was leaking into the oceans. It was actually benefited them. They made a lot of money off cleaning that up. So those are some real wrong aspects of measuring how your society is doing by gross domestic product. Now, next thing to discuss, when did we start calculating GDP? Okay, because it actually turns out that up until 1991, we were using gross national product instead of gross domestic product. And now, why was this not beneficial for us? It's because right around 85, 86, 87, the trade gap started to widen between America and China. And we always used to have a pretty even trade gap, and our manufacturing was essentially being outsourced in the 80s to China. So there got to be a point where the GNP was making China look a lot stronger, and it was really a lot better for us to just use GDP. Now, the reason why is because gross domestic product only takes into account what is being bought and sold within the country. All right, GNP counts for things that are being bought and sold by the people within a country internationally and locally. So it includes exports and things like that. So when China was getting more exports, their GNP was looking a lot stronger. As our trade deficit with them widened, it behooved us to move these numbers in a way where we wouldn't really have to focus on the fact that we don't sell anything to the world anymore. And because the world does a lot more exporting to us, we do the importing. It will lower their numbers if we go with GDP instead of GNP, because the GNP would include everything that they sell to us. And so it makes a lot of sense for them to change that number, which they did in 1991. What do Ted Turner, old George Bush, and Rupert Murdoch all have in common with Robert Mosbacher? They're all yachting buddies. Like as far back as the 60s, 70s, and 80s, they were all in yacht clubs together and going in sailing races. There's documentation of Mosbacher and Ted Turner getting into a race where, Mosbacher beat Ted Turner by 5 seconds or something like that. So making them old-time rivals. Now, Ted Turner being the founder of CNN and Rupert Murdoch being the founder of Fox, two of the largest mainstream media conglomerates in the world. And they rubbed elbow with this guy. So I don't know, who was responsible for changing the way we calculated GDP? I'll leave that one up to you guys. So number 3, unemployment numbers. Most people know this, but I don't know if you know how bad it is. All right, so I want to take a look at a comparison of this chart. I believe most people know this, but it needs to be in here so we can really see the difference, because there's what we call official unemployment numbers. There's U3 and U6. You might want to call it U1, U3, U6. U6 is much more closer to the real accurate numbers. What is often missed when we're talking about the unemployment numbers, jobs numbers, participation rate, is really what type of jobs are we really talking about here? I mean, are we just looking for having a lot of jobs? Because if you take a look at the top employers, either in the United States or worldwide, I don't think you'd actually find that these are the kind of jobs, companies that you'd want to work for. I mean, how many people go to college in order to work for Walmart and Amazon? How many people have to sacrifice their life in the military in order to have a military job? Because the number one employer in the world is the U.S. Defense Department. Here, why don't we take a look at what Indeed says are the 25 top jobs right now in America. Number 1, cashier.
Is anyone really shooting to be a cashier? Is that what we want to create as an entire economy of cashiers? Food preparation work. Well, I mean, everybody does need to eat. That doesn't mean everyone has to work for everybody else so they can eat. Stocking shelves at a retail location or an Amazon warehouse is a noble feat and very difficult work. And I think most people who take on that job would like to see themselves be promoted to something where they don't have to work that hard at some point. But that's the third most common job in the US right now. Fourth is a laborer. That has to do with construction, and being a laborer is a way you get into the construction industry and you're able to kind of get experience, become a carpenter, perhaps a general contractor, and work your way up. So that one is hard work. You get your body beat up every single day. Not often do you get paid sick time off if you get hurt. And a lot of times you're dealing with chemicals, materials that nobody's really insuring for you for the long run. Number 5 is a janitor. Number 6, construction worker, right there with laborer. I'm cool with that. Bookkeeper. Okay, you need somebody to count the beans. So bean counters, number 7. A server of food. That's number 8. A medical assistant. It's all right, we have to have our health care. And then number 10, a bartender serving alcohol to patrons at a restaurant, just like these. These are our top 10 careers. And I think that when we start talking about employment figures and the economy looks strong and everybody is employed and looking for jobs, I mean, these aren't the type of jobs that we were raised to go to college with specialized industries and to pay, hundreds of thousands of dollars in student loan debt in order to become a bartender. It's not why we went to college. So you can't have a specialized workforce and then throw out a bunch of service industry jobs and then tell everybody the economy's strong, there's plenty of jobs out there. And what we know very clearly is that we have to look at how many job vacancies are out there. And that is a more clear indication of economic unemployment during downtrends and recessionary times. And we're going to have to be using that a little bit more common. And of course, that one's manipulated too. Okay. Why do these unemployment numbers always seem to not reflect the economic conditions and the inflation around us? And it's because they're constantly being tweaked and constantly being lied about. Unemployment numbers are incorrect. They always have been. They always are going to. And number 4, consumer sentiment. Oh, Jesus, if this is not the most arbitrary, foolish number that you could ever hear of. So Michigan State Consumer Sentiment Index is so old and antiquated of something that we shouldn't even put an ounce of attention into it. I mean, most of those people are answering the calls by landline. They call 500 people a month, and they ask them 5 questions about how they feel about their economic situation and what's going on with the world, or has their life improved or unimproved over the past year. They call 40% of the same people, and 60% of them are new people. Now, I'm sure I've never gotten this phone call, and I'm sure none of you have ever gotten this phone call. But how easy would it be to just set your Rolodex on the same 1,000 people and rotate it from one month to the other, or keeping some the same and then, going back to others before, and just basically having the same demographic of people answering the same question as well. You can then focus that demographic in on people that watch a lot of Fox News or MSNBC or any of the mainstream media, people that stay off of YouTube, stay away from alternative media. So then they're able to gauge and actually manipulate consumer sentiment based on the media narrative and what's going on with the news that they trickle in to let somebody know if the economy is doing good or doing bad. So as the economy is going down, as the stock market's going down, they have this condition in the mainstream to be able to explain, yeah, but it's this, it's peak inflation. Inflation is transitory. We're at peak right now. It's coming back from here. They always have a certain narrative that they can express in order to soothe and calm the boomer generation that still has a landline and is still watching Fox News and MSNBC and is mostly just stuck with mainstream media narratives. And that's why consumer sentiment kind of always goes the way the news says it should. And so for me, consumer sentiment talked about every single week in the news. Consumer sentiment is talked about. Completely arbitrary, horrible demographic chosen from. There's no way you could get the idea of how like 330 million people in a country feel based on a survey of 500 people once a month. That's just embarrassing. I don't even have to go any further into it. That is completely broken economic indicator, and no one should even look at it at all. Moving on. All right. Consumer spending. This one's not the worst gauge overall. So consumer spending, as we look at it, it's really, consider it like a fraction of the GDP calculation that we went over. So you could say that GDP is a larger factor, but the largest factor within GDP would be consumer spending. There's a couple problems with that, is that you really don't have a really strong economy if just the ability for consumerism to work around and retail sales and buying and selling of goods is not really innovation. It's not really productivity. It's not really growth, like the type of growth that we see in tech. So when it holds such a large standing in a certain other economic calculation, it really actually matters. So 70% of GDP, that's huge. Okay, but is it really 70%? Or is there something wrong? See, let's, flash back to when we talked about in 1991, how they changed GDP over to GNP. And why they did that is because they wanted to exclude the global calculation of everybody's, economic health. They wanted to exclude exports and countries making money off of other countries, because that would behoove a country that imports more, has a negative trade balance than a positive trade balance. And so we talked about that, and this is so tricky of the consumer spending. Okay, so in the consumer spending number, actually about anywhere from 10 to 20% of that number is actually based on imports. So this is consumers buying goods from other countries. It goes into the consumer spending number, which gets baked into the GDP, and the GDP is technically gross domestic product. So there's anywhere from 10 to 20% of the 70% of the GDP at any given time that's not supposed to be there. It's not supposed to be baked in. It's not supposed to include consumers buying from imports, because this is talking about domestic products. So it's a sneaky little thing. Sometimes it'll make a difference of 5 or 10% in the calculation of GDP. But as you can see, when we're going into recessionary times like now, 5%, difference in the change of GDP could be the difference between our second negative quarter of recessionary activity. So, if we see something like that here in the end of June, after Q2 is over, we're going to be in a recession, boys and girls. And that means we're in one right now. If it's just whether or not they call it. They won't call it till late July. All right, 6, last but not least, the CPI. The CPI, along with the PPI. Have you ever noticed how they never call it the PPI? Could it be In an industry full of dicks that nobody wants to be caught saying that thing out loud on TV. Okay, so what is wrong with the CPI? Everyone knows what it is. Consumer Price Index and the Purchaser Price Index. As famously noted by many YouTubers and people bringing out the truth over the years, the CPI data and how they calculate it has changed since the 80s, the last time we ever saw inflation as high as we see it right now. Now, first, it's really good to understand the difference between a consumer price index and the purchaser price index. The difference is that the people that make the stuff for you have to buy the raw materials to make that stuff. Those are the purchasers. You, the consumer, buys whatever they make. You're the consumer purchasing price. And those two prices are extremely relevant. There's also the wholesale price index, which does not get talked about as much because there's a lot more places where they can fudge the numbers inside the CPI and the PPI, as we'll get into now. How about the fact that economists can just change the basket of goods in which they calculate the CPI, kind of like what you do when you go and you get a new cut of steak and you see the prices for your steak go up, so you get one cut lower. The economists do that too when they're calculating the CPI. Take a look. Right here is a graph of the CPI calculation if no substitutions had ever occurred. That's the blue line. And with the substitutions that they've made over the years since 1991. 1991 being a really curious date as to when a lot of things changed in terms of, what was it? When we calculated GDP differently. Look, it looks like they started calculating CPI differently then too. What's even more incredible, inflation doesn't include housing prices. It used to. Guess when they stopped? 1983. Right after the last time we had inflation this high. And it was largely due to mortgages and debt from housing. So what did they do? They switched the calculation over to rent. And by rent, what they mean is a spitball and a rough guess on a Friday night after you worked all week. And they call some owners, like a survey sort of situation again, and they ask them what is their owner's equivalent rent, which is what is their opinion about how much they think they could rent their house for based on the neighborhood. And perhaps they might ask another house how much do you think that house could be rented for? And that's how they gauge housing prices. It's an opinion. They're asking owners what they could rent things out for. Unbelievable. By the way, this chart here showing the difference in this calculation from 1980 versus now. This was done by a website called Shadow Stats, and Shadow Stats database was hacked, and that website is no longer working. So you can find, when that happens to a website that has key information, you can go on to the Wayback Machine on archive.org, or you can go into a Google image search for things like this. Is where I found this particular chart, just to let you know. We have discussed the top 6 economic indicators and why they are broken. I think it's a kind of funny thought if you think about why they roll out these data points to us at different times throughout the month. Imagine if they dropped all the data on one given day, what would happen to the stock market on any given day? They just drop consumer sentiment, GDP, CPI, PPI, unemployment statistics, all the earnings for all the different companies came out on the same day. Imagine the turmoil that it would be. So I think there's 2 reasons. One kind of like a good reason, which is, they string these pieces of information out throughout the month to not shock the system. They want to have a smoothly moving liquid market with not too much volatility. It's one of the reasons to dole out the information to us slowly, even though they already have the data right away. And yes, we can confirm that CPI data leaked the day before. That's why the market tanked the last hour and a half before the 10th of June. It was because CPI data lived. And, I'm certain that the SEC is right on top of it. They are looking into this. They're going to find out who leaked that data, and they're going to get those guys who profited off us retail investors. I'm sure of it. Now, the truth is, I could have kept going with this list. I could have gotten into debt restructuring within the mortgage and retail space. I could have gone into manufacturing data and how that's manipulated. But I think we get the point. Fed is always going to be wrong because they're always using the wrong data. If it's not the wrong data that they're using, then is it that they're just that out of touch with the common people, the average middle class person in the United States or really anywhere in the world to understand how inflation hits them, hits home, and how just being concerned about asset valuations, the value of the dollar, and unemployment, a blind unemployment that's strong is, and a blind GDP that looks strong is all they're mandated to do. They've lost all the tools to do it other than to print money, and now they print money, and it leads to our bonus talk of the day. Okay, so I always like to talk a little bit further than just this information. So what's more insidious than economic data and being incorrect and the Fed not tackling inflation on time? What's more insidious than printing an unfounded amount of new money into the system? What's even more insidious than then talking about quantitative tightening this month as if it's going to have some sort of lasting effect on the situation? All that money that was pumped into the system, about 40 to 60% is average, that was created through the quantitative easing cycle just since October 2019 up until they stopped that policy in March of 2022. All that money can be fractionally lent against. And what that means is roughly, whatever that sum is, roughly 90 to 900% of that money will be increased in the pool of money from loans that go out from there. So there's the initial loan from the Fed to the banks, and then the banks loan it out. They do a fractional lending system where they create that money out of nowhere from money that was created out of nowhere. This can be done up to 900% on $100. So that's $900 for every $100 you get, or extrapolate that off of about 5 to 6 trillion since the QE policy really began way back in 2013 and 2011. 2013, I believe, was the first QE one. Beyond the economic indicators, beyond the inflation rate, beyond the Fed's tightening cycle, beyond all of that, there's this other underlying thing that's devaluing our currency. And that's whatever money was created has now doubled or tripled in terms of the velocity of the loans and the mortgages that have been loaned out for these investments, for margin, for stock buybacks. And those asset valuations are now in a bear market, which means they've gone down much more in most cases than 20%, but as a market average, over 20% since the start of the year, and many other companies much worse. So all that money's gone. Whoever sold those and is holding that cash, it's out of the market and it's out of our hands. And we have more down cycles to come. So getting on top of inflation is going to be so much more difficult because there are so many factors other than our broken indicators that aren't being included, along with the still increasing money supply. Even though the technical factors of us no longer doing QE is the narrative in the mainstream, fractional lending is just the snowball effect of QE, and that will be going on and on and on. So inflation's here to stay. We know that because their target rate is 2%. Now here, why don't you take a look at a chart of how successful the Fed has been at hitting 2%. And yeah, you can take a look. I don't see it hitting 2% at any particular time. And it's all well and good for you to go ahead and average those things out of time, but who is it that made you decide that 2% was the right inflation amount when in fact the Fed was brought in to have zero inflation, to have that perfect parity of price stability? That's their mandate, is price stability. How can you have a stable price if you have a 2% inflation target? That's not stable. That's an always increasing price. Now, why don't you take a look at the actual inflation since the 40s and 50s, since the chart goes back? Let's take a look at it right here. You're going to see inflation only goes up. There is no dip to buy on inflation. So this concept of deflation, or this concept that we have price stability, it's completely thwarted. And until we get our economic indicators accurate, we're not even going to be able to have the conversation in the mainstream narrative and mainstream media that we're going to need to have in order to get some more equality and parity of pricing in our stock market. So thank you all. We're going to keep working at it. We needed to get some context around some of these statistics. I had to get this content out. It was itching at me for so long. It has been since I was younger, because lying with statistics is the number one way that we're in the situation that we're in. And so we have to address the statistics, as boring as they are. And as much as any average day trader is not really going to care, like whether this is the right thing or the wrong thing. For a day trader, the question is, what's the price action? What's it going to do? It's always good to know the psychology behind it, because if you just want to go on the mainstream narrative of how the market's going to go up or down at any particular time, it's not going to take into account the algorithmic institutional investor narrative, which is taking into account all of these economic factors and whether they're correct or incorrect, and how the Fed is handling it. So it's all about the money, baby. It's all about supply and demand. Easy as cheesy. Just stay focused. We'll keep working. See y'all around, people. Like, comment, subscribe, please. Trying to grow this channel and get my word out to more people, because this is one of my favorite things to talk about. I like talking about it with you all. Everybody be good. Have a wonderful night. More information to come. Peace.
Our depreciation the year before that. Depreciation is a real expense. It's just as much as, the expenditure for lights. It's not a non-cash expense. It's a cash expense. You just spend it first. The cash is gone. And it's a delayed recording of cash expense. How anybody can turn that into something they use as a metric that talks about earnings is beyond me. Charlie?
Yeah, I think you would understand any presentation using the word Ebitda if every time you saw that word, you just substituted the phrase bullshit earnings.
I knew he'd do it sooner or later, folks.
And the man,
he made it through the morning, but never all day.
And the man asked the question also, says, what remaining big accounting troubles exist? The real Lollapalooza is pension fund accounting, and to some extent post-retirement medical liabilities. Those are horribly understated now in America, and they're very big numbers.
I've looked